Hi, and welcome back to this set of videos on how to make journal entries. From the last video, recall that I presented the process and I asked myself the question, does this affect cash? If yes, I continue to make the journal entry. If no, then I ask, does this affect accounts receivable and accounts payable? And if yes, I continue to make the transaction. Um, the journal entry, and if it's no, then I work with what's easiest. Okay, so let me give some concrete examples, and we'll actually, go through this so that you'll see what I mean. All right. Let's say that let's talk about the one for rent. We're going to pay rent, and it's $1,000, and we're going to pay it using cash. Okay. So that's the transaction. I'm going to have a bill that's a piece of paper that says, you know, your rent is due. All right. So how do I make the journal entry? And realize that, yeah, you could have looked this entry up in the book, but what we're doing is we're working with, the thought process for entries that you won't find in the book, or if you don't want to be looking them up. So, right, the first thing I'm going to do is I'm going to ask myself the question, does this affect cash? Okay, in this case here, yes, it does affect cash, because why? I'm paying the rent using cash. Well, now from previous videos in the framework, okay, you should be familiar with what I'm talking about. If you watch those other videos, you'll see you should have these concepts down. Okay, cash is an asset. Okay, the category, when I'm looking at cash, it belongs to the category of account called an asset. Okay, and we know from the other videos that when we want to increase our asset, we increase it on the debit side. And we want to decrease it, we decrease it on the credit side. So here I have, I'm affecting cash, right? Now, am I increasing or decreasing my cash? Well, I'm paying the $1,000 in rent, so I'm decreasing my cash. So the first half of my journal entry is going to be a credit to cash for $1,000. Okay, that's my first half. Now, we know that all journal entries, the debits must equal the credits. That's an inviolate rule, okay? Whenever you make a journal entry, it has to be that way. Otherwise, you're wrong and you're not going to get your books to balance, okay? So if I have a credit here, that means I have to debit something else because my debits have to equal my credits. So what am I going to debit? Okay, well, you don't, immediately you're thinking, oh yeah, rent expense, because I used that in the last video and you've probably seen it in the textbook, but you need to think through the thought process. Just like with affecting cash, I thought about the category of account, which was an asset. Okay, I'm going to think through my different categories of accounts, right? Assets, liabilities, equity, revenue, and expense. Okay, what's the nature of this transaction? Well, I'm paying rent. Well, is rent an asset? No, it's not something I own. Is a liability? Well, you can say, well, yeah, I owe it because that's what liability is, but really it's used in the operation of the business. It's not, like a loan to a bank, or it's not where you're buying something on credit. Okay, so it's not a liability, and obviously, it's not equity, right? Because it's not an investment in the business. Okay, it's not revenue because it's not a sale, so it has to be an expense account. Okay, so all I need to do is then look at my chart of accounts, right, or my trial balance, and look at my general ledger accounts under those expense accounts and choose whatever expense account seems the most appropriate. Okay, in this case, it happens to be rent expense. Okay, and that means I would debit, for 1,000. Okay, so basically what I did is I backed into that journal entry. Okay, I started out with, does this affect cash? And the answer to that question was yes. I decided if it's increasing or decreasing my cash, and in this case it was a decrease, so I credit cash for 1,000. Then I asked, I know debits have to equal credits, so now I'm going to figure out the other half of the transaction. The other half, I look at the categories and ask, is this an asset, is it liability, equity, revenue, or an expense? And when I decided it was an expense, all I needed to do was just look at the general ledger accounts and choose the rent expense account. I backed into that half of the entry. Okay, I don't have to be trying to figure it out. Okay, I'm going to present one a little bit later that is a lot more difficult. Okay, and you'll see why I'm doing it this way. Okay, now let's say we have we're going to buy some supplies from Home Depot in the amount of $300 on account. Okay, on account means on credit. Okay, so if a transaction occurs where I'm buying supplies for $300 on account, what's the first question I'm going to ask myself? Does this affect cash? And the answer to that is no. Okay, so if it's not affecting cash, then I'm going to ask myself the second question. Does this affect accounts receivable or accounts payable? Okay, and the answer to that is yes. Okay, it's going to affect accounts payable because it's on account. So I know that accounts payable is a liability account, and I know that I increase my liabilities on the credit side and decrease my liabilities on the debit side. Well, if my liabilities were zero before, I didn't owe anything before, and now it goes up and I owe $300, well, obviously that's an increase from 0 to 300. So when I know that my liabilities increase on the credit side, that means I'm going to credit my accounts payable for $300. Now this is where we back into the other half of the transaction. Okay, I know that debits have to equal credits, so if I credit something, credit one account, that means I have to debit another account. Okay, well, what other account is that going to be? Well, I'm dealing with supplies. Okay, now here's where, here's why looking at the categories of account becomes important, because if I say, I have assets, liabilities, equity, revenue, and expense. Okay, if I look and I say, is this an asset? Is it something I own? Okay, could these supplies be an asset? And in some circumstances it could. Okay, if I was buying supplies that I'm reselling, okay, as part of inventory, well then yeah, that would be an asset, and I would look under my asset accounts and choose the appropriate inventory account. Okay, but in this case here, these supplies are being used for maintenance, like fixing plumbing or something like that. Okay, so it's it's going to be used in the business. It's not going to be an inventoried item. It's not going to be something we own. We're immediately using it. Okay, so it can't be an asset. Is it a liability? No, we don't owe supplies, and it's not equity because equity, supplies aren't an investment in the business, and it's not revenue because we didn't make a sale, so it has to be an expense account. Okay, and all we need to do is look under our expense accounts and choose the correct account, which would be supplies. Maybe it might be supplies expense for $300. And there I have my journal entry, right? Debits equal credits, my debits of 300 and credits of 300, and I have, the correct journal entry. I backed into the supplies expense and it just automatically made it, made the journal entry correct. What I don't want to do is I don't want to start with supplies, okay, just like most students do. They try to start with supplies, and then they're going to get confused because they don't, they're not choosing the proper category of account. They're not choosing the asset or an expense account. Okay, they're just going to supplies and they look at their chart of accounts and they see a supplies account, and that happens to be an asset account. So they debit the supplies as an asset, okay, and they get it wrong, right? Because they didn't think through the category of accounts and they didn't back into it. Okay, so that's the reason why we're going that direction. Okay, all right. Now, let's say we have a let me think of this here. Okay, let's say we're going to, we have an asset. Let's say it was a vehicle. Okay, instead of vehicle, I'm going to just call it a car. Okay, let's say we have a car, and that's an asset, and we need to depreciate that asset. And let's say that depreciation for the month is $500. Okay, all right, we need to make a journal entry because we're going to depreciate the car, right? So the first thing that we ask is, does this affect cash? And the answer to that is no, right? Well, if it's no, then we ask ourselves the second question: does this affect accounts receivable or accounts payable? No. Okay, well then we move on to the third thing and we do what is easiest. Okay, and this goes back to how students have a tendency to want to work with the second half of the transaction first. Remember, when we're working with cash, generally we're talking about 60% of the transactions. Accounts receivable, accounts payable make up about 30% more of transactions, and everything else makes about 10%. Okay, so we work with what's easiest. In this case here, we're talking about depreciation, and if we look at our chart of accounts, we'll see that we have a depreciation expense account. And we'll also see that we have an accumulated depreciation. Let's call it vehicle account. Okay, depreciation expense is obviously an expense account. Okay, and the accumulated depreciation expense is an asset account. Okay. Well, like I said, let's work with what's easiest. And the easiest thing to work with is the depreciation expense, right? Because why? We know we're depreciating and we know it's an expense. Well, if you look back in the other videos, we'll see that for an expense, right, we increase our expense on the debit side and we decrease it on the credit side. Okay, well, if you imagine you had 0 depreciation before and now you have 500, that increases. So we're going to increase it on the debit side. So we'll make that depreciation expense a debit for $500. Okay, and if our debits have to equal our credits, okay, then that means we need to credit something else. Well, what else? Okay, again, we look at our assets, we look at our liabilities, equity, revenue, and expense. Okay, well, right underneath assets, we see the accumulated depreciation account. Okay, we're talking about an asset, we're talking about our car, and we're decreasing the value of the car. Remember that when you have an asset that you're going to depreciate, you'll have vehicle and less accumulated depreciation, and that will give you some net amount. Okay, so by looking at our chart of accounts and saying, okay, this looks like an asset, and for our assets, right, we increase our assets on the debit side and we decrease our assets on the credit side. Well, if our asset is decreasing, in other words, it used to be 40,000 and now it's $500 less, right? That's decreasing. Well, then we would credit our asset for $500, credit that contra account. So that falls in line in my journal entry, debits equal credits, 500 and 500. Okay, it really is that simple. All right, it's not that much more difficult. Okay, so whenever you have a journal, whenever you're working with a journal entry, okay, you have a transaction, the first thing you should be asking yourself is, one, does this affect cash? Because we affect cash most often, and we know that cash is an asset, and we know that we increase it on the debit side and decrease it on the credit side. Okay, so when we figure out whether our cash is going up or going down, whether we're going to debit it or we're going to credit it, that's 1/2 of our transaction. And we do that again and again and again. It should become a no-brainer as to whether cash goes up and down, debit or credited. So then we ask ourselves, we know that our debits have to equal our credits. And in doing that, that allows us to be able to back into the second half of the transaction by looking at the different categories of accounts and seeing the nature of that transaction, which category it actually fits into. And when we decide that, then all we need to do is just look at the accounts underneath that, and that becomes the second half of our transaction. Okay. If we ask the question, does this affect cash, and it doesn't, then we'll ask, does it affect accounts receivable and accounts payable? Okay. Now, if the answer to that is yes, and let's just say it's accounts receivable, okay, notice that accounts receivable is just like cash. It's an asset, okay, and it follows the same rules. So if you know how to do cash, then you know how to do accounts receivable. If my accounts receivable before was 0 and it goes up to 250, that's a debit. Okay, if it goes down, right, from 250 down to 0, that's a credit. Okay? So and it follows the same exact thinking as cash. But now let's say we have a transaction where someone is paying off an accounts receivable. Okay, well, the first question I'm going to ask is, does this affect cash? And the answer to that is yes. Okay, and my cash is decreasing, so I'm going to credit my cash. Let's say it's for 250. Okay, and then my debits have to equal credit, so what am I going to debit? Okay, well, when I look at my assets, liabilities, well, under my assets, I'm paying off an accounts receivable, so automatically it has to be accounts receivable. Okay, for $250. Okay, and that's not right. Oh, I'm sorry, I got that wrong. Oh boy. All right, sorry about that. Let me back up here. I was thinking something else, sorry. Does this affect cash? Yes. My cash is increasing, so that's a debit to my cash for $250. Okay, so debits have to equal credit, so I credit something else. And that something else, I look at my assets, and it has to be accounts receivable for $250. That's the right transaction. Okay, not the other way. Sorry about that. See, even experts make mistakes. Okay, so that's that's how you work with your accounts receivable. You treat it the same way as cash, and you should become very familiar with that, just as you become just as familiar with cash. But also remember that accounts payable is just the opposite of accounts receivable. So there's no need to memorize both receivables and payables. If you understand how to do receivables, then you should be able to understand how to do payables. Okay. And then the last thing you do is if it doesn't fall into cash and it doesn't fall into receivables and payables, then you work with whatever is easiest first. Okay, you choose the account that you find easiest to work with, and you debit it or credit it. Then you say, okay, my debits have to equal my credits. So if I make a debit for something that's easy, then that means I have to credit something else. And you go back into the thought process of what category of account, choose the account, and you've made your transaction in that respect. Okay, I hope that was understandable. And if not, feel free to give us a call, and we can work through it so that you do understand that thought process. Okay, have a great day.